Well, hello everybody. This is Ken Winans from Winans Investment with Stephanie Larson, and I know we haven't had a video out for a while, so I wanted to make sure you all knew that we're still here doing our thing and doing the best we can. So obviously, this is we finished up the third quarter. We're going into the fourth quarter of the fall, and as we've talked about before, the fall is always an interesting time in the market, really from late August pretty much through October. There's always some softness in stock prices, and the number one thing that I would say is we're just really watching closely how individual companies report their numbers. We know there's a lot of noise about that the holiday season might not be as strong this year because of just shortages of goods out there. So we'll just have to see how that plays through. But the next 2 weeks, in my opinion, are critical on which stocks we will buy going into November, December, January, and just to get a sense of where those positions, at least the forecast of earnings going into next year, lies. So that's a big part of that. And then, of course, in the other part of our world is what's going on in income investments.
Yeah, the bond side has actually been a little bit of a challenge this year. Prices have been really strong. But one of the things, and I wrote about this extensively in the quarterly commentary. So if you should have that in your Tamarac portal. If you haven't received it, let me know. Just email me and I'll send it to you. But one of the things that we're watching really closely is what the Fed's doing, right? So Jerome Powell has made it pretty clear that they are going to start tapering. It is going to be this year. We don't expect rates to go up this year, but they are going to go up. That actually will help the bond side for two reasons. One, prices will soften, so it'll make it easier for me to buy some bonds at better prices. Two, the yields will actually have to go up to compensate. So all new issued bonds that will come into the market will be at a higher yield, which is why the prices will go down for existing bonds. If the existing bonds have lower yields, they're less desirable, so the prices go down to compensate for that, right? So the bond market actually could get pretty interesting, and it'd be a really good time to buy. So we really want to be ready and primed to go the second that the bonds prices start to soften, and then we're going to just jump all over them. So
There you
good.
go.
Yeah.
We're ready to pounce on the bonds. There we
Yes.
go. We're ready to do it.
Yes.
If you haven't done it, I wrote an article in September called "The ABCs of High Inflation," and it dealt exactly with what people who are trying to rotate their portfolios into more income investments. In other words, people's portfolios have gotten a little out of balance right now because stocks did relatively well. We're in the later stages of a bull market. I still believe that's very much the case. So how do you rotate without getting hit hard with inflationary pressures, which typically can hit longer term bonds? So I think the article will help clarify that our strategy is already set up for that. It's something I designed a long time ago. I came out of that old inflationary world, so it was still very much in my mind early in my career about the ravages of inflation and what you have to do to protect yourself. A couple other quick things. We at this point, we're still trying to vet changes in brokerage houses. I know we talked a lot about Fidelity, and we've elected right now to hold off on any changes now that the TD Schwab merger has been basically moved out a couple of years. We just didn't want to aggravate the process right now of trying to move people around. So although we're still vetting our choices, we'll be back to you probably early next year with what we've determined is going to be in Q1.
Yeah.
The other thing I would bring up is in the case of the commodity exchange traded funds. When we first talked about commodities, and many of you know I have a background in actual futures trading. I did that in Chicago for almost 2 years. And the ETFs are still a new animal for us. When I'm talking about the exchange traded funds that are supposed to mimic what's going on in the commodity world. So needless to say, I haven't been real happy with the way many of them have acted, whether it's because of liquidity or whether it's just because they're just not tracking really what I was hoping to do. So you've noticed that we've trimmed back on many of those. I have not given up on the commodity play yet, but we need to go back and reanalyze which of these ETFs we want to use going forward. So again, it's part of the issue of being in portfolio management is you try things, see if they work, and move it there. And in many cases, the stocks that we actually own are in many ways a commodity play to a second degree. So something else. A good case in point would be anything in energy. We have a lot of energy bonds, and we certainly have companies that are industrial companies that do work with the energy sector as well. So it's certainly, we're not going to miss out there. The only other thing I was going to bring up This market is very headline driven. You know, every day, Steph and I, we talk every morning. I'm always sending her a text or she's sending me a text on some piece of news. A good case in point with what happened to Southwest Airlines over the weekend with all these, 2,000 flights being canceled. It causes volatility in the markets. And so we have to sift through event driven volatility from what the underlying trend looks like. So as of this point in time, we're treating any pullback in the market as just a pullback in a bull trend, even though I do still think it's a late stage bull market. So we will plan to commit money in November and December as we get ahead on where earnings are. So we, whatever cash you see in your accounts right now, I do like to play the seasonal bounces of even, I'll bring up, I remember in 2008 when the world is as scary as it could possibly be and we were facing 50% corrections, the market still bounced back in November and December, even in the midst of that horrible thing. I remember in 1987, I remember November, December, the market bounced back after the crash. So although there can be volatility, there's a seasonality to these things. So with that being said, you will see us selectively making choices in the portfolios, both on the bond side and certainly on the stock side.
Yeah, I think yeah, that's a good point. I mean, we talk a lot about this. I mean, again, it's in the quarterly, but Ken and I talk about it all the time whenever we get in touch with clients, right? I know there was a lot of concern with the pullback at the tail end of September. People concerned is like, oh, is this a start of something new, or is it seasonal? Is it a correction? Is it standard? I think Ken and I both believe it's a standard correction. It's actually a sign of a really healthy market. If a market just does this, it's not healthy. You want to have it pull back and in and out. And so, while we weren't concerned with that, obviously, we had a really strong summer run up, and then September, obviously, it kind of bit into what happened in the summertime. It gave back most of the run up. I think it was through the start of July or June. You were looking at that the other day.
Yeah, we're talking about the market overall.
Yeah,
Gave back
market.
most of the rally through the summer was taken
Yeah.
back in a couple of weeks, which, as Stephanie has said, is very much
Yeah.
part of what happens in the fall usually.
Yeah, but I know, some clients, and it's funny because we have a spectrum of clients, some that are very risk averse, some that are are not, and they see maybe cash in their account, they go, well, should we have more cash because they're conservative? Or some see cash in the account, they go, well, buy something. It's like, but we think there's gonna be volatility for 2 more weeks. I don't want to buy you something. So we are playing the seasonality game here. Like Ken said, the holidays tend to have a lot of euphoria around them. Everyone's warm and fuzzy, and Christmas lights are everywhere, and people get together for the holidays, and they're buying things. So part of what our hesitation is not only the seasonality, but we are a little concerned that companies' earnings projections are going to be softer. And softness will not bring euphoria. So what investors are looking out for is how soft are they, how much is this supply chain pinch that has been happening, which is a real thing. You can't live in California, either in LA or by the bay, see hundreds of boats in the bay or in the ocean waiting to offload containers and can't, and not know that there's a supply chain issue here. So we're just trying to see what the guidance from the retailers are going to be, and that will also either make it a really strong holiday season or a softer one. So we just want to see how that reacts. That's why we're sitting here, and we know what our research is. We know the names we want to buy. We know it's been soft. We like buying the dip whenever we can, but we just want to wait a little longer just to see what the guidance is, and then I think we'd feel a little more comfortable really going after a few of the names that we want. Enjoy the run up to through the holidays, and then we'll reassess in January and see what happens then.
And one final point is just, COVID is still here. The Delta variant obviously is beginning to affect. We're hearing it in some of the early reports coming from companies. At least it's the excuse being made for softness in their financials. So we have to be somewhat cautious that although we all had hopes that the mask would be off by now and we could enjoy the holidays. I recently have had to fly a couple of times, and the masks are still on. It's still heavily enforced, as many of you know, and it probably will be going into the foreseeable future. So we just need to be prepared as we look towards next year. Is the economy strong enough to withstand this ongoing, long-duration event? And then in addition to that, have that happen with the Federal Reserve cutting off the free money spigot,
Yeah.
raising interest rates. Inflation is still, I said a moment ago, inflation is with us. And as I've talked to people, more people are beginning to say that, Ken, you were right. When you first said this is not going to disappear quickly, we're seeing that ourselves. So again, it's a change. And in that change, investments will have to, the kind of investments we buy will also be adjusted for these new norms, for lack of a better term.
Well, and I want to really hone in on something with this. With our investment style, so the way that we approach the bonds, I know Ken touched on it, but I really want to emphasize this. The way that our portfolios are set up with the ladders, with the bonds, it's actually perfectly geared for an inflation market. So I know people hear inflation, and if, some of you might actually remember it. I personally don't. I wasn't alive in the 70s, so date myself on that one. But our portfolios are actually specifically designed to tolerate inflation and to maximize it. What we can have in the investment pool. So I know it's out there. I know it's scary. People think, oh, it's just going to eat into our portfolio. Not necessarily, actually. I mean, it's not that you won't touch it, but we will maximize and take advantage of the higher yields once they hit the market. We're chomping at the bit to get them. So, we will be okay with our strategy.
Absolutely. Last point, and then we'll let you all go. I know it's very tempting to want to do knee-jerk asset allocation changes to your portfolios. I highly encourage you to finish out the year with the allocation you have right now. Let's see where we're at in January, and then if you want to make, adjustments because of facts, not necessarily on how you feel about the world, but on the facts of your own life, whether it's eyeing retirement, simply needing more income because cost of living is going up. I would certainly, those are the kind of logical steps that is part of what we offer in how we do things. A couple other quick things. I'm still doing my pieces for Forbes. Stephanie and I are still working together on research pieces. Also, ABC Radio in Los Angeles is having me on weekly. So if you'd like to go on their website, the podcasts are all there. It's the Frank Motek Money Hour. If as you all know, I enjoy doing radio, and
It's really good.
no, thank you.
Yeah.
Yeah, every now and then I get it right. So anyway, but just know that we're here for you. We're working hard every day. The staff is healthy. We're all doing well. We're learning to navigate this world, especially with all these moms with their kids that, with school, trying to figure out which schools are open. Even on today, like Columbus Day, some schools were open, some were closed. It's still a hit and miss with things. But anyway, we wish you well. We'll put out another video probably in about a month.
Yep.
And we will hopefully see you again sometime in the early part of the year.
Yeah, and then, of course, at any time, if you ever need anything, reach out. We're here. I'll just touch one last thing. We've had a lot of clients reach out lately because they are going through different transitions of their life, retirement. I've had at least a half a dozen phone calls of these as of late. If you guys are ever concerned, or you yourself are going through a similar situation and you want some advice or to evaluate your financial situation with us, that's what we're here for. So, scary times, but we've been steadfast through all of COVID and working and here for you, and we'll continue to do so. So we'll reach out after earnings season.
Yeah.
And we'll do another video, touch base, let you guys know. You'll see movement in your portfolio probably before then. But at any time, we're always here.
I know. I would say one last thing. I did want to bring this up. Many of you have year-end requests within your portfolios. Situations with the brokerage houses are still a problem. Amy and Mindy are on hold so much of the time. I'm constantly hearing the Schwab and TD Ameritrade music playing out of my office. I'm not kidding. It's on. Ask Stephanie. She's next to it too.
It's on right now.
It's on right now, exactly. So I'm just going to suggest if you have any gifting. We know about the minimum distribution requirements with IRAs and all these things, but please don't wait until the second week of December and think it's going to go according to plan. Folks, we're still a long way back from the old days when things were done efficiently and effectively at the custodian level. So I would highly recommend any special requests, get it in by no later than mid-November.
Yeah, especially TD people, because I know they've started to close some of the TD offices.
Yeah.
So it's getting tougher. So, but anyways, we'll be in touch. We'll speak soon and be well.
Take care.